Hi everyone, welcome to today's accounting design project. Today we have Kirti from UT Dallas to talk about intangible asset valuation from a historical perspective. If available, we encourage all the participants turn on your camera so we have a more engaged conversation with Kirti. Kirti, you have 60 minutes and the floor is yours.
Perfect. Thank you so much. And first of all, good afternoon, everyone. And then I would like to just begin by thanking Ayung and Stephen for inviting me to present my paper on intangible asset valuations in financial reports. And this paper is a joint work with Chari, who is currently at DoorDash, Mike Andrews, currently at UMBC, and Rajkamal Vasu, who is at Temple University. Just a fun fact about this paper. This paper is actually very old. It started when I was a PhD student at Northwestern University. And the three co-authors on this paper are my Northwestern buddies. The first two, Chari and Mike, from the econ department, and Raj is from finance department. He was doing PhD in finance at that time. So we all have had a lot of fun working on this paper. So without further delay, Okay. Let me just dive in. So I think the graph that I'm showing you right now, most of you are already aware of this fact that intangibles have been increasing over a period of time. I think the investment in intangible is becoming or having a larger share of GDP compared to tangible investment. And while the graph here is just as of July 2025, given the advent of AI and machine learning and all these big software tools and techniques, the intangible investment is particularly in the last year has also increased significantly. I'm sure when we see this report in July 2026, which is a Intan Invest database report, we would see a larger divergence between intangible and tangible investment. So I think one of the fundamental things or the questions that we researchers should focus on is if this intangible investment is growing, how can investors know more about these investment? Of course, as an accounting audience, we all know one of the most important sources of information for investors is accounting reports. So how does accounting report currently looks at intangibles? Again, I'm sure a lot of us are aware of how they are treated, but just for people who may not be as familiar with the setting, I just want to talk a little bit about the current treatment of accounting intangibles. So internally generated intangibles as of today are typically not reported on financial statements as asset. And I think the reason I'm saying typically is because there are one or two exceptions where costs can be capitalized. And again, the emphasis is on costs, and I'm going to talk about it in a little bit, but costs related to software development or costs related to oil and gas exploration can be capitalized. It's an entirely separate debate, and I really don't want to digress myself to talk about how many firms essentially do capitalize these costs. But these are at least two methods through which these internally generated intangibles can show up on financial statements. And the reason I emphasize costs is because even in these two specific cases, the cost that is being incurred related to software development cost or oil exploration are being incurred, are capitalized, not necessarily the value of that intangible asset that would eventually be generated as a result of these costs. And the third way, which again, I think there's a lot of debate and there's an entire parallel literature about R&D expenses that show up on income statement, right? So, I mean, a lot of researchers have tried to proxy, R&D costs as internally generated intangibles. But again, one thing I just want to highlight is that this is again cost and not necessarily the value of innovation. So our paper is more about the value of innovation, and I'm going to come back to it when I'm specifically talking about the research question. So this is all about internally generated intangibles. When we look at acquired intangible assets, as of today, US GAAP requires that all acquired intangibles be reported on balance sheets at fair value at the time of the acquisition. And after the purchase price allocation method, this acquired fair value needs to be reported in broad categories such as patents, trademarks, customer relationships, etc. Again, while they are reported in broad categories, something I want to just emphasize is that they are not itemized. You cannot really go and see a firm's balance sheet and figure out within one category, let's say patents or trademarks, what exactly intangible items that the firm has. Questions, or should I just continue? Okay. So I think before I talk about this particular call for research by FASB, one of the, again, this is such a vast area of discussion, but the current treatment of how how intangibles are treated according to US GAAP has been subject to some debate. Of course, there are, one from investor side, investors want to know more information. So they are saying that I can see acquired intangibles, but I don't see internally generated intangibles on financial reports. And then on the other side, there is also an academic debate where we see multiple viewpoints. Two primary viewpoints is the current way the accounting standards are treating intangibles seems fine because accounting is more about reliability. And with internally generated intangibles, you really cannot provide an estimate of value. But there is another viewpoint that actually talks about the information is relevant for investors. So let's just give them all the information out. So because there's so much debate in academic circles as well as, amongst investors, the accounting standard setters have also been debating this for a very, very long time. I think the most recent discussion was around a 2024 symposium. Of course, there were some comment letters as well that FASB had requested last year. But for the 2024 symposium, FASB specifically asked for evidence about balance sheet recognition of intangibles. In fact, they said they need more evidence regarding the measurement basis of intangibles. Whether intangibles, particularly internally generated intangibles, be capitalized? If yes, at what basis? Should it be cost? Should it be fair value? Should it be some other method of valuation? Then there has also been discussion about whether we should provide aggregated information or disaggregated information. And most importantly, should we continue treat acquired intangibles differently than internally generated intangibles? So I think while these are all very important questions, the biggest obstacle as a researcher we face is that we only see snapshot of accounting standards as of today. We only see when acquired intangibles are capitalized and internally generated are not, again, typically. So it makes us wonder as a researcher, what if there was a setting where the firms reported all intangible assets, the information about all intangible assets. And here, I just want to emphasize that our focus throughout the paper is on intangible assets such as patents or assets that are innovative, that generate some future economic value. So we wonder if there was a counterfactual, if there was a setting where we could see all this information, would we be able to provide some evidence to this debate and maybe perhaps inform the policymakers? And that's where our paper comes into the picture. We use a historical setting, which is the 1919 Illinois Blue Sky Law. And as you can see, of course, this setting is 100 years old, but we believe in the absence of any other counterfactuals, we can still utilize this setting while accepting all the limitations that it may have, that it is 100 years old. Firms have changed over a period of time, technologies have changed, but I think we can still learn from this setting. Why? Because this is a setting where there were alternative intangible asset disclosure rules. Primarily, firms made no distinction between acquired and internally generated intangibles. And they were required to disclose itemized list of all intangible assets, acquired or internally generated alike, as well as the reported value. So the firms were supposed to provide the value of individual intangible asset They could choose a method of valuation of their choice, but the condition was that they had to report the valuation method as well. So when I'm going to talk about the setting in detail in the next few slides, I'm going to be more clear about this particular aspect. For our paper, we again focus on patents. So we don't focus on assets that don't generate future economic value. We focus on patents because this is a type of intangible where we can provide some evidence about usefulness of reported valuations. Because patents are the asset where we can measure in some sense long-term value of that asset. Okay.
So why can't you do that for software or brands or other things? Why is it patents that only are unique?
So patents, I think it's particularly because of the data, the way the firms provide the data in the financial reports is that for patents, they provide the serial number of the patents that we can easily, connect to the USPTO website to eventually see how many people have cited that patent. So we can create a measure of the future value. So in terms of the brands and trademarks, we really don't have a measure of the future, importance or a future value of that particular asset. Particularly in this setting where we don't have a time series of financial reports as well. We are primarily relying on the first filing that firms made under the Illinois Blue Sky law while they were issuing the security. So it's more of a data limitation based on the sample that we have. Yes,
So I think in general, I have like two clarifying questions. So one is kind of like related to what Sudipta talked about. Is that intangible assets includes many different type of asset classes. You
Yes.
tend to focus on only the innovative capital, but there's a relationship related intangible assets. For example, companies can get favorable lease terms if they actually build a relationship with the lessor. There's a marketing brand related. So it seems that your motivation for focusing on just the patent-related intangible asset is due to the data availability, but it seems that it's kind of disconnected with the broader scope. Like when you talk about the cohort papers, I think FASB is kind of considering all sorts of intangible asset in seeking. So I think that some clarification in the paper will kind of help mitigate that gap between the broader interest versus what actually you focusing on. And then related to that is that even within the innovative capital, I think patent only is a tip of iceberg of all the innovations, because I'm sure your co-author from DoorDash will say a lot of internally developed software apps, inventors kind of do not seek patent protection because there's a limited protection compared to other situations. So I think the first question will be, what's the scope actually you investigate relative to the motivating question? Yeah.
Okay, so I think I absolutely agree with the points that you have made. And frankly, we amongst the co-authors have debated this, how to position this paper. But I think we always believe that you always start with a big, broader research question. Like that's ideally is what we want to answer. And then we are kind of narrowing down to the setting which can provide us the best estimate. So frankly, maybe what we can do is in the writing, we can bring it out more clearly. But ideally, if this data was available, we would love to test it for other intangibles as well. For us, I think the data is definitely a limiting factor where we can only look at patents, and these are also, once I talk about the details of these firms, you would also see that these are unlisted firms, so we also don't even have stock prices. So that's another limiting factor for us to be and that's why we are trying to be creative and trying to see what evidence we can provide. But point well taken, and we can definitely update the writing to reflect that.
Can I have a quick follow-up? I think there's a literature related to the marketing related intangible asset using trademark information with the USPTO. So that would be something in terms of data availability. USPTO should have a trademark information overlapping your sample period as well. Yeah.
Okay, we can definitely look at that. Yeah, thank you. Yeah. Yes, Vakar.
Hi, I just wanted to double check with you. So with the patents, if the company is paying a regulatory authority for patenting the activity, would that not naturally be externally generated anyway? You're acquiring it by default. So where does the choice between acquired and internally generated come from for the patent if it is paid for?
Are you saying that the cost of generating a patent, including the legal cost, you're talking about that versus buying a patent from another entity,
So
another
maybe
firm?
I'm not sure about the variety of patents, but what I had in mind was that the patenting activity itself has this acquisition sort of activity going on in which you're not giving yourself a patent, you're getting a patent, right? So how does that differentiate from internally generated intangibles the way we know them?
So I think, okay, so let me just maybe talk about it a little bit and just clarify this. So when I say you're internally generating a patent, that's basically some research and development you have done internally. You have spent some money while creating this technology patent or some other kind of patents. And then, of course, in order to get this patent, you would also incur some legal costs. So when you say a patent that's internally generated, I'm talking about all the R&D expenses or all the expenses that you have incurred while developing this particular patent, plus any legal costs. But this cost, again, this is a cost that you have incurred in getting access. I wouldn't even say access. This is the cost of a patent that you have generated. Now, the value of this patent can be determined by the market. When somebody, let's say another firm, is coming and trying to acquire you, they may value this patent a lot more because they believe that based on this patent they can build a lot more things. So there's one aspect about cost of generating this patent from the firm's point of view. And then when somebody else is trying to acquire it, it's about the value that they see in this patent, and that expectation, that is what is built in the price that
Rather
they are
than
willing
calling
to
it patent, would it be reasonable to say it is proprietary technology of any type?
pay. Sure, yes, maybe, yes.
Because patent, as we know, is a regulatory concept that you pay the government for 10 years or something, and then you secure that market share or imitation, right? So I think it's also about something to do with the sort of the labeling of intangible, so to speak. So I think it might be better to clarify that by patent you have a loose definition of anything which is proprietary or anything technological that is proprietary, so to speak.
That's absolutely right, because as you know, as Ayung was saying earlier, that not all technology is patented, right? I mean, there are some internally developed technologies that firms have that they use on a day-to-day basis, but they don't patent it. So of course, ours is a much smaller sample of those proprietary technologies that the firms are trying to develop.
But I think Wakar has a point in the sense that the legal costs can be capitalized under US GAAP. So that's separate from the R&D costs. And so I think it's worth making the distinction.
Okay, sure. Yeah, we'll be, I think we can definitely make that distinction here more clearly. Thank you. And so let me just move forward. Second. Okay. So just a quick background about the Blue Sky Law. So the Blue Sky laws were initially, they came into existence in around 1911 in Kansas. And at that time, I think the reason why the Blue Sky laws came into existence was that the Kansas Kansas state was worried that there were a lot of fraudulent firms that were trying to sell securities to naive investors. And there were a lot of cases where, investors were fooled by these promises by these firms that eventually went bankrupt, and investors lost a lot of money. So in 1911, Kansas was the first state that said that we want to protect our investors from firms that are promising these blue skies to the investor. So that's where the name, that's where the name came from. And after 1911, and there were a lot of other states that also adopted various versions of blue sky laws. In 1919, Illinois adopted the Blue Sky Law, but it was very different from prior Blue Skies laws that came across the US, primarily because they made distinction very clearly that all the firms that were not listed on stock exchanges had to submit reports to the Illinois state regarding securities that they wanted to issue. So this was a very clear and a big distinction compared to the prior laws in other states, where Illinois said if you are listed, we don't really need to see anything. But if you're not listed, then you have to provide us a lot of information before you can issue securities in Illinois. And what was this information? This information was about the business, what kind of business description there is, what are the names and addresses of the officers and directors, financials, balance sheet. Again, I'm writing it here, income statements, but at that time it was mainly profit and loss statement. How much money you are trying to raise, how much, how are you going to use these funds? And then I think the most important for our setting is that you had to disclose itemized description and value of all intangible assets. I think this is more about, these pictures show how we collected this data, because this data is not available in a digitized format. Okay, so this data is available in Springfield, Illinois, in Illinois State Archives. So when we were PhD students, like, in 2018 is when me and my co-authors went to these Illinois State Archives. We requested these financial reports, and then we literally took a picture of every single page of the financial reports. And as you can see on this slide, some of the reports had a lot of pages. So it took us a lot of time. And that's what makes our paper a little bit different compared to other history papers that we have recently seen in top accounting journals, that we don't have a digital version of these filings. So the data, again, whatever we could collect, we did spend a lot of time, but it was literally every page had to be scanned or had to be pictured before we started transcribing anything. Regardless, we do have a decent sample to work with, but I just want to, again, I'm sorry if it's not readable, but here, if you look at, there's a company called Moline Heat, and the number 14 line item here basically says patents, trademarks, etc. And I think this goes back to what Ayung was saying. We can look at trademarks as well if there is enough information about them. So it is available on the balance sheet, and the details were available in schedule number 6. And here on the left-hand side, Moline Heat was providing the itemized patents, as you can see where I'm scrolling, and the value was given for the entire portfolio, whereas some firms were providing valuation of individual patents that they have. So while the law said that you had to provide itemized valuation, in certain cases, firms said, we are going to give you itemized assets, but it's very difficult for us to value them separately. We can only value them together. So that's where we see valuation as a portfolio compared to itemized valuations. And I know this is a question that comes often when I present. Are these audited? And sometimes, so actually, we have collected some data about audit reports, not in detail, but some of our sample is audited, and not all of the firms. I'm just going to be very, very, honest about it. Not all of these are audited. Sometimes, and here just a picture to show you, it's from Ernst & Ernst, from Ernst & Young, but it is, dated 1919. And it talks about, what kind of things firms are doing and what kind of opinion the audit firm has. So what we did is that we hand collected these filings from Illinois State Archives during the period 1919 to 1937. So this is basically set of firms that issued securities in Illinois during the period 1919 to 1937 were subject to the Illinois Blue Sky Law. Overall, we have 1,700 plus filings and 683 distinct firms. And something, again, I just want to highlight, at these firms are all unlisted firms. Do you want me to look at the chat as well, Ayung? I think there's a question there.
Yeah, I think I have a similar question as the chat. So I have two questions. Since I want you to go through the details, the institutional
Okay,
details
yes. And I
as well.
think that question will be answered in the next slide. So
So
yes.
like two questions, probably you will address next is that, does the law actually define what's itemized? Because it made me think about the segment reporting, right? Can be as aggregated as US international, or can be as meaningful as iPhone 14 versus 16. So is any information about the regulatory guidance on to define the boundary of itemized intangible asset would be helpful. And then second is the measurement basis, whether that is an input cost base or this is expected output value or commercial value versus scientific value. For example, citations will be scientific values may or may not overlap with commercial. So I think those potentially can address some of the.
Yes, I will do that. I think the next slide is about the measurement basis.
Yeah.
And regarding your comment about itemization, so yes, again, it did mention, and maybe I should have had some excerpt from the law itself, but it did require itemization of individual assets. So they specifically talk about individual intangible asset that the firm has. The firm had to list. So again, this is little open-ended, and that's why we see in some cases firms didn't do it, but in a large number of cases they did. But I think we can be more clear about these, and maybe we can provide some excerpts from the law itself.
Yeah, I think just a follow-up on the individual, try to think about internal, within a firm, like what would be the chart of accounts? Like how do they actually classify intangible assets in terms of how granular it goes? And then some clarification on what exactly the itemized actually mean. It can be one category, just all the intangible assets, or two categories, only register intangible assets will be reported, patent, trademark, or holistically everything possible like the company can think of.
Okay, so at least like there were these, like, you know, you had to disclose your patents like item by item. You had to disclose like trademarks. Yeah, you had to, I think there were other like goodwill had a separate line altogether, which was available on the balance sheet. But for other intangibles, like I can check, like, I mean, what exactly for the patents and trademarks, the law specifically talked about it. The others, they were quite vague. They didn't provide that detailed information about them. Yeah.
Thank you.
Okay. And for the valuation basis, let me just finish this slide. The next one is going to talk about the valuation basis. As I said, like these filings were done by firms that were trying to issue securities in Illinois. And so we focus on the first filing, the first time that the firm is trying to issue securities, because that was the time when the filing was the most complete and most consistent. While we do, look at other subsequent filings for some of these firms, but I just want to caveat that these subsequent filings are not necessarily giving us a time series of their financial data. For example, if someone issued securities in 1919, maybe they'll do a subsequent filing in 1922 or 1925. And that could be, again, maybe trying to raise more securities, or they are just giving some update to the investors. So for our study, we focus on the 683 first filings. We do have some additional analysis when we look at all the filings, and that's in the appendix. Again, the focus is on a class of asset, which is about innovation. So we look at the patent subsample, and 165 of 683 firms do report identifiable patents, and our analysis at the patent level. So for these 165 firms, we have approximately 3,700 patents that we link to the patent data to get patent characteristics, as well as to get the measures of importance of these patents. Now, I think the most interesting part about our data set, and I think this is what makes the paper very different from what we have seen, elsewhere. And again, all other studies are also equally good. All I'm saying is that our paper differs in the fact that this is probably one of the only settings, and again, to the best of my knowledge, where you see different measurement bases. So firms could choose, while they had to provide a value of intangible, they could choose the valuation method themselves, as long as they were disclosing the valuation method. So let's say a firm purchased a patent, they could either report the value based on the acquisition price they paid, or if they decided to appraise it, they could also provide that value as well. But in both cases, they had to say that I'm going to use the purchased valuation method, or I'm going to use the appraised valuation method. So as long as the valuation method was disclosed, you could choose any valuation method and provide valuation according to that. Does that answer your question? Okay. And again, interestingly, so as I said, you could value patents in multiple ways: purchase price, which is the price that you paid at the time of acquisition, or appraised price, which could be a professional or estimated value. And frankly, this was a very interesting exercise for us co-authors to actually see that how were they really appraising it, right? I mean, so was there DCF? Like, what exactly were they doing? So while DCF was not there in the formal way, they were like informally trying to apply DCF, some of these external appraisers. And in fact, the law, again, maybe I should have had the excerpt on the right-hand side here. The law actually asked that whoever was appraising it, they had to provide a proper, like a signed document saying, this is how I appraised it, etc. And then third was they could just use valuation based on the cost that they had used, including the legal cost. And finally, the fourth method was nominal method. And where the people, where the firms were just recording intangibles as often, like sometimes $1, $10, or some nominal values just to signal existence. And then we do have some cases where valuation is provided, but method was not disclosed.
I think Sudeepta has a question about amortization cost, or amortization related to the valuation. Yep.
Okay, so yes, so we do have amortization, and again, at that time they were using this another term, extinguishable, right? Like extinguishment instead of calling it amortization. So we do take that into consideration as well. And even the firms, like they were talking about that this is the the fair value when we appraised it, and less the amortized value or the extinguished value is what they were reporting on the balance sheet. Suresh, you have a question.
Kirti, quick question. So do you have a same discretion even for the tangible assets? Can you pick and choose different methods and do the report? What kind of methods they're using for the tangible assets, or this is the discretion only for the intangible assets?
That's a very interesting question. At least in the law, like we did not, I think for tangible assets, like there was at least what we have read in the law, like they didn't provide these options. But that's a very, okay, we haven't even thought about it, but that's pretty interesting.
I mean, to the extent that that data is available, I mean, you need to go back and collect it, right? You can do a lot of counterfacts. You can compare tangible versus intangibles.
Yeah, okay. That's a very, very interesting. I think we do have the overall intangibles. We haven't overall tangible assets, where when we're looking at the distributions of for to check for manipulation or uncertainty, we look at the total tangible assets, but we haven't really looked at like how they were valued. But that's a very valid point. And now that we do have all these financial reports, and I think we have better technology to get data out of these, I think that's something we can definitely look at.
Hey, Kirti, I also have a question. I'm just curious.
Yes.
Actually, for the given patent, can they change the measurement basis from year to year?
That is such a good question, and I think we really were hoping to look at that as well. As I said, like frankly, we don't have good time series. And in most cases, all the subsequent filings are not as detailed as the first filing. So like, so we did try to look at that. There's some cases where we did see subsequent filings. We did not see that they changed the valuation method. But again, in large number of cases, the subsequent filings are not even detailed for us to figure that out.
Yeah, because your figure 4 is very interesting. It seems that the valuation method or basis, it kind of fluctuates with economic cycle, right?
That's right.
The question and all that, people are going to pivot to or just put a $1. That means that I'm not going to give the market any valuation.
Yes.
Because we are at the bottom of the economic cycle, right? Yeah. So
And
that
that's
is-
also kind of like will tie back to like our findings later on, that this choice is kind of informating. So we're going to talk about that. And I think for nominal, the use of nominal assets, I think we have Sudeepta in the audience who has the most authority to talk about that. In fact, I've learned a lot from his papers about like why firms were applying these nominal values. So I would leave that. That's an entirely separate discussion. So I wouldn't digress right now. But yes. Nominal was a method that was being used by firms. Like it was during this time that it became popular, and it continued for a very long time, eventually resulting in SFAS 2, right? I mean, where everybody started expensing R&D. But anyways, like that's a separate discussion. So again, I just want to like circle back to what FASB wants to know. And again, something I want to highlight, that why we believe this setting is powerful. I think this setting is powerful because it directly speaks to the FASB's agenda. The first thing is about recognition. Should internally generated intangibles be recognized on balance sheet? And I think here it is a very unique setting where we do see that internally generated intangibles are there on the balance sheet. The second important thing about FASB's agenda is what measurement basis we should use. So far, the studies that we have seen are typically looking at the costs, but we don't have access to this kind of unique setting where we have multiple valuation methods and we can actually compare them to each other. So I think this is a setting where we can provide some suggestions regarding the measurement as well. And finally, I think there is this whole debate about aggregation versus disaggregation of intangibles. Even though acquired intangibles are provided on the balance sheet, they are broadly reported. They're reported in broad categories. So should there be more disaggregation of that information? And I think here is a setting which is, again, to the best of my knowledge, is a setting where we see itemized intangible assets rather than aggregate reporting. So we believe our setting mirrors the core agenda of core issues at the center of FASB's agenda, even though, again, it is 100 years old. So yes, Vakar.
Great work and great historical emphasis. I just have a concern about selection in that, and I'll explain that. So, modern rules, research, R&D, any internally generated intangible, the fear is it's not going to recover value. There is no sort of probable benefits in the future, and so to speak. Do you think these people, these old companies, they already cross that bridge in the sense that when they do include details of this patent backed by machinery, other details, they already think that this qualifies for the definition of an asset? Mind you, this definition doesn't come around until the 70s when FASB was made, right? So some of those concrete concepts around the recoverability of the asset or whether economic benefits will flow and control. So do you think these companies are already thinking that, oh, this is a serious investment which will definitely accrue to us and it's not going to fizzle out in the next 1 year? So do you think that selection is playing out in the background? And in that sense, then the R&D debate would still be unsettled because that's where the pressure point is with FASB, right? They think, oh, if only 10% of R&D is successful.
So I think what you have just mentioned, Wakar, that's an amazing point. And in fact, that is a point that we have talked about, like not just amongst co-authors. Every time I've presented this paper, one of the questions that has been asked to us is that how, this setting is 100 years old, maybe things are very different. But I think one thing that I always say is that the uncertainty about the future economic benefits of an intangible, or in this case, patent, was still there 100 years ago as it is today. So, I mean, there is no way, even at that time, like the firms that we have in our sample in 1919, when they were generating that patent, they didn't know what value it would eventually create, right? So there was no way for them to know. And in fact, if what you are saying was correct, we probably would find some correlation between the valuation amount that they were attaching to these intangible investments to the future economic value, or our proxy of future economic value, which is the future patent importance or lifetime patent importance. But we actually fail to find any of that evidence. So frankly, just by looking at the historical setting itself, I believe some fundamentals remain unchanged. The uncertainty about innovation, what it is today, was also there 100 years ago. And I think that kind of makes our paper very, very important for current debate. So like that's how we feel about it. And in fact, another point that was raised was kind of opposite of what you are saying, that maybe now firms have better technology to figure out what future economic value might be there, right? And to counter, what I say is that even now, and I'll give you an example, which is OpenAI. When OpenAI came, everybody was blown away, right? I mean, look at the valuation of OpenAI right now, it's $500 billion. But do you know that Google had created the exact same technology 7, 8, or 10 years ago, and they had been using those LLMs internally without realizing its potential for the outside, right? So if Google knew, oh my God, this is an amazing technology and what future economic value it's going to generate, they probably would have made it as commercial as OpenAI did. And frankly, I know this because I know a lot of friends in Google who had been using those LLMs for a very long time. So I think like there are both viewpoints, and frankly, what I believe and what my co-authors and we believe regarding our paper is that uncertainty, I think, is very, very fundamental and about any innovation, whether it's today or whether it was 100 years ago. Yes.
Hey, Kirti, I just want to remind you have 20 minutes left. And
Okay,
we're still
okay,
on
okay,
slide
sure.
14 out of 41.
Okay, thank you so much. Yes, okay. This is a perfect time that we are finally here at my research design. So basically, our fundamental objective is to understand whether the values that the firms are providing are these values predicting the future economic value. And again, because it's very difficult for us to identify the economic value, we rely on a proxy, which is the future importance of the patent. And ideally, we want to just like correlate these two measures. One is the importance measure and the reported value, and see if there is any correlation or not. And the reason we use future patent importance as a proxy for the economic value is because of, the primary reason that it's very difficult to know the economic value. The closest that the literature has looked at is the stock price based measure, Kogan et al., where they develop the economic value of patent based on the stock prices, but which is something that we can't do in our setting because these are all unlisted firms. So we rely on a text-based measure of lifetime importance of the patent. It is based on Kelly et al. Paper 2021, where the text-based measure is essentially the textual similarity of the patent. The numerator has a similarity for the patents that come after this particular patent, and the denominator has a similarity with the patents that came before this patent. So the idea is that you should be more similar to the patents that come after you, but you should be less similar to the patents that came before you. So that kind of shows some, market invention kind of thing, that people are building up on your research, but you are not building up on somebody else's research. So it is more unique. So this is impactful patents reshape subsequent technical language. And this is again something I just want to mention, that we believe that this measure is still a pretty good measure because it captures the realized technological importance rather than relying on stock price based measures which reflect the market expectations. Lastly, even if there are concerns about this measure correlates highly with the Kogan measure of stock prices. So we feel comfortable using it for our analysis. But I'm happy to hear any suggestions that you may have for any other measures that you may have in mind. Yes, Suresh.
So even though these are unlisted firms, do you have some kind of profit loss statements going forward once they disclose this information? Do they keep reporting it? And can you use some kind of operations related metrics like ROA, things like that, in addition to this particular measure?
So we have considered, but again, as I said, we don't have a time series. So we do see some filings in some cases of firms, like some subsequent filings, but we don't really see after this disclosure what exactly did this firm do. Like that would have been amazing That's probably the suggestion that I've received, and I would love to do it. The only thing is we are constrained by data. We do have some citation-based measures as well that we have put in appendix, and our results are pretty much similar. So we do try to use another measures. But again, a quick caveat that the citation measure, because the citations at that time during our sample period were not as greatly, there's no databases that look at the citations as carefully up until I think 1940s or 50s. So that is again with a caveat, but we'll still have that analysis in the paper. Okay, so here are the results, and what we do find is that the patent valuations that the firms provide are generally uncorrelated with the long-term importance. And again, this was a bit surprising, and we do add a lot of fixed effects. We look at different, fixed effects as well as structures, and this result remains robust. So here, for example, we do patent by patent level data. We also do this analysis by aggregating the patents into the portfolio if they were valued as portfolio, and we find very similar results. So what we find is that the amount that the firms have provided is not correlated with the future importance, which kind of suggests that the numbers themselves don't add much value in these disclosures. Then we also look at, is it possible that for itemized patents, these numbers would predict something, and to our disappointment, we find that whether it's itemized or whether they are acquired, the numbers that the firms have provided, they are not predictive. But what we do find is that if you itemize, if the firms that choose to itemize, the choice of itemization predicts higher importance. So there is a choice of what method you're using. Are you valuing as a portfolio? Are you valuing as itemized? That choice itself provides some information even when the numbers don't. And the same thing when we look at acquired versus internally generated valuation numbers. And this was actually surprising to us because we were hoping that at least firms where the valuation amounts for acquired patents would probably be correlated with the future importance, but we don't find we fail to find any evidence regarding that. And similarly, we again find that the patents that are acquired, they tend to be more important compared to the patents that are internally generated, at least in this sample. And I think our most important result is the one where we utilize all the valuation methods that the firms have provided, because here we can actually compare different valuation methods to each other. I think most interestingly, interestingly or maybe like uninterestingly, we don't really find that if it's a patent is valued at purchase price, that number versus at cost versus nominal, they do not predict. And I know, some of you would say that if you look at the coefficients on the nominal valuations, they do seem to predict the future future importance of the patents. The last two columns are the most exhaustive set of fixed effects. That could be, but it's a little bit difficult to understand because these are nominal values. So they are literally $1, $10. So those values are somehow predicting the future importance is a bit puzzling. The most interesting thing is the fact that the patents that are appraised, their valuation figure is negatively correlated to the future importance. And that kind of raises some suspicion about, are these numbers really manipulated? Maybe when firms are trying to get it appraised, they just put a number pretty high because they could. And that raises some manipulation related concern, which we'll talk about a little bit later. Again, another interesting finding, while the amounts are generally not predictive, we find that the choice that the firm makes is informative regarding the future importance. So if you are using a nominal method, and this is, I think, goes back to what Ayung was saying about figure 4, some firms is using nominal method, and that itself can tell you the firms who are using nominal method, they probably have patents that are more valuable, or the firms that are using at cost and to a certain extent purchase price as well. So this was a very interesting finding, and mostly, through all our results, what we find is that amount is not informating. So the number doesn't have the forecasting power, but the method does. So which is kind of a very interesting and a nuanced kind of finding, which I will talk about in terms of policy implications a little bit later. Why we believe the choice is informative, and maybe let me talk to. I think Ayun has a question.
Oh, I think for your earlier results, the nominal is that once they have 10 patents, that will be $10 because each patent will assign $1. So is that how they use the nominal approach?
So when
The
it's
number of distinct patents they have at the time when they disclose, so the nominal method pretty much just the count of patents.
So when you're saying like if it was valued as a portfolio, right? Because if it was valued itemized, then of course you see nominal values at the itemized level. But when you're saying that it is itemized as a portfolio, and I think we did do some analysis, and I think our results still hold when we looked at the portfolio as well. But I'll double check that. Yeah.
Deepak has a question.
Oh yes, Sudeepa.
So one, public companies were reporting $1 for the total portfolio. So I don't know what how you're seeing it. Secondly, though, on the previous slide, did you test for the differences between the coefficients? So if you have 5 coefficients, did you test if they're equal or unequal?
Yes, yes. I think I'm not showing it here, but like for example, I think we did test the coefficient on purchase price, at cost, and nominal, and they are not statistically different from each other. Yes. So why our methods can be informative, and I think this is methods can act like managerial signals. And I think here again, I think I know that there is a paper by Sudeepta where they are actually looking at within the whole the oil and gas exploration capitalization area. They find something similar that firms, because when firms can capitalize their oil and gas exploration costs, they have a choice of doing it one way or the other. Again, don't want to digress too much. But Sudipta's paper also shows that the choice itself is informative, that certain types of firms choose one method, whereas the other types of firms choose another method. So I think our paper kind of complement those findings to a certain extent. And I think the next thing, because I have 8 minutes left, let me just quickly go through about other tests that we do in the paper. I think we were very intrigued why these valuation amounts are not predicting future importance, right? Because one reason could have been noise, but in the interest of time, I didn't put some of those results here, but we did correlate that measure with some obvious firm-related and patent-related factors, and it does correlate pretty well. So it's not a noisy measure. So then we wonder whether the lack of correlation results from the fact that firms are manipulating these numbers, or is it that they don't know what exactly to put as a value, or is it the uncertainty about the valuation? So the first test that we do is about manipulation, and we rely on Benford's law, which is used by scholars and practitioners to identify earnings manipulation, any kind of fraud. So the idea is that the digits of unmanipulated data follow a distribution which looks like what you see on the right-hand side. This is what the distribution should look like if the data is not manipulated, and this is known as the Benford's law. What we find is that we actually plot the first digit of distribution for patents and assets and other balance sheet items, and we find that the patent distribution does not, we fail to find any evidence that it violates the Benford law, and more importantly, we don't see any differences between the distribution of first digit for patents versus total assets. And we are not just visually inspecting it, we do run statistical tests to see if there are any statistical differences between the two. Same thing when we compare patents to real estate, they pretty much follow the same plot, same with machinery. So, so that kind of makes us, believe that maybe valuations are conforming to Benford. So probably, again, with a big caveat. This is based on the limited data we have, but we fail to find evidence of widespread manipulation. And there was one exception again. The appraised valuations are more likely to violate the Benford's law a little bit, which is kind of consistent with what we found in our valuation tests. And the last thing that I want to talk about is once we rule out manipulation, we test for the fact that maybe firms were uncertain about these valuations, and that's why they could not precisely estimate. And that's why they just throw in some numbers, which eventually does not correlate with the future importance. And what we find is that patents do show disproportionate rounding, and a lot of them end in zeros. They are less likely to use cents. They're more likely to end in zeros. And then they're more likely to have focal values. A focal values is a number where after the first digit, every other digit is a zero. So the patents are more likely to have focal values. We also rely on some economics literature to look at last digit distribution to check for uncertainty. And this literature suggests that if there is uncertainty, you are more likely to see zeros or fives as the last digit. So we do find that for patents, there is higher likelihood of last digit being a zero. And we map it to total assets where we see an uniform distribution. Machinery is a uniform distribution, and real estate is more or less a uniform distribution. So what we find is that it's probably the uncertainty regarding the value of innovation itself that results in the lack of correlation. But, and here I think I'm doing pretty good in terms of time. I would like to conclude that our paper we believe, is an important first step towards providing some evidence to FASB's agenda. Our paper shows that the disclosure about intangible valuations can be informative, even though the numbers themselves might not be informative, but the choice of valuation method can be informative. So what does it mean for standard setters, or what implication does it have for the policymakers? We believe that accounting information, the usefulness goes beyond just the numbers. What we should ideally do is probably provide firms the flexibility to select one of the valuation methods and then provide as much disclosure as they can, given that they disclose the valuation method that they're choosing. So the numbers don't probably have that much information, but the other content, the disclosure decisions, the choices about how they want to disclose can still be informative to investors. Yes, Ayung.
Given that we have time, I think I'm going to ask these questions. So I think before we conclude it, I would like to hear more about some underlying kind of like institutional details about back then, 100 years ago. What are the specific tools and ability for firms or anyone to assess expected value, economic value of any intangible asset? What kind of bookkeeping systems? What are the logistics for actually put ourselves in their shoes and then try to go through one pattern you could observe and think through that, how does that eventually would generate revenue, and then ex ante, how do anyone is able to estimate that? Because I feel like one way to interpret your result is some of the firms chose nominal value. It's just because it's not worth their efforts, because whatever they try to estimate, it's going to be 50-50%. It's not new information. And that trade-off led firms to give up on estimating something that is too hard because the information barrier, the technology, or just is highly uncertain. And then think about back then, we don't even have internet. People are on horses or walking, right? What are the barriers actually faced by constituents back then to go through this valuation test, leading to potentially not very informative estimates, and then how does that actually carry forward 100 years later in terms of how we think about whether we should have some measurement requirement for intangible assets?
Okay, so I think that's a very, very valid point. And I think we have spent a lot of time like really digging deep into the history to see like what exactly people are trying to do. And I think I may have an appendix slide here, which I can, so here is a slide which kind of something that we have looked at, that what exactly did people do. And again, this is mostly focusing on DCF, but I think there were versions of DCF that the firms were using. They had the idea of the expected future cash flows. They just didn't call it DCF. They also evaluated, like gross profit. Like again, this is mostly for tangible assets, but even for intangible assets, I read, I think there's a maybe Yang paper in TAR in early 1920s that talks about like how appraisers would actually try to figure out how valued that innovation is. They would try to see other innovation that the firms had done. So they were like doing a lot of these activities. And even like there is this parallel literature about how railroads are valued at that time, which was in the late 1800s. And I've read that most of the time they were using something similar to DCF to come up with these valuations. But like it's very fascinating. Maybe we can bring in some of the discussion in the paper also. Yeah.
Thank you. Do you have the slide for the next event? And
Yes, I do. Let me just go back to my conclusion slide and my thank you slide. So I would like to thank you everyone for being here. And I'm so glad, like, again, so grateful to Ayung and Stephen to invite me to present this paper. And I would really encourage all of you, if you're interested in intangibles, you don't want to miss next presentation by Richard Sloan on intangible asset specificity. So thank you so much once again, and looking forward to seeing you at the next event.